This is FinTech Takes, the podcast keeping you in the loop on all the latest FinTech trends, news, and ideas. I'm Alex Johnson, creator of the FinTech Takes newsletter, your host and self-confessed FinTech nerd. Let's go! I know that here on the show we talk a lot about the importance of bank partnerships when it comes to the success of any type of embedded finance or fintech endeavor. So let me tell you about a provider that is raising the bar in embedded finance. Built by Fifth Third Bank, Newline enables enterprises to launch and scale payment products using their API-first platform, enabling embedded solutions that scale responsibly. Learn more about Newline by visiting newline53.com. Hello, and welcome back to FinTech Recap, where we recap what's happened in FinTech. My name is Alex Johnson, publisher of FinTech Takes, and I am joined, as always, by the delightful Jason Mikula, who is the publisher of FinTech Business Weekly, but who also has another job title, which we, I think, discussed on our last podcast. But please refresh our memory on your super cool job title that you've added to your LinkedIn.
Yeah, I joined Taktile, the next-gen decision platform, as its head of industry strategy for banking and fintech. And I'm actually recording this in Berlin, where one of its offices is, and the entire company, or more or less the entire company, has gathered for, I guess if you're here, it's an on-site, but if you're based somewhere else, I guess that would make it an off-site. I don't know, branding questions. But yeah, it's my first time in Berlin in like 10 years.
Awesome. I am jealous. I am both a big fan of Taktile, as you know. I am also deeply in my bones a credit decisioning nerd above all else. So I'm jealous of all of the nerdy credit decisioning topics that you've undoubtedly gotten to get your hands into. Although, Jason, if I can try to make you jealous a little bit, I did just get to nerd out on loan servicing, so not credit decisioning, a little later in the life cycle, loan servicing, but I got to do so while at the Bonneville Salt Flats outside of Salt Lake City, Utah.
The servicing is the important part because it's where you get the money back.
Yes, that's exactly right. That was essentially, you just summarized my fireside chat that I did, and it took me about 30 minutes to say what you just said in 3 seconds. So well done.
But should we get into it?
I think we should. And Mr. Mikula, I don't know if you can hear that off in the distance, but I think that's Bass Island music. Is that Bass Island music? Is that what I hear?
It sounds like another trip to Bass Island.
All right, give us the update.
First, I have to push back briefly on our friend and text chain colleague Jason Henricks, who credited you with inventing the term Bass Island. We co-created. I went back because I have no life. I went back and listened to that episode, and you said Bass Land, and then at the end of that segment, I made a joke about Lord of the Flies on Bass Island, and thus 1,000 memes were born.
Okay. We have officially established for the record that it is
50-50 ownership.
And honestly, I feel lucky to get the 50% given the story you just shared. So, all right, I will defer to you as let's call you the primary inventor of Bass Island.
At any rate, stuff that people actually care about. A couple of interesting developments. The sort of most headline-grabbing one is that the FDIC has proposed a rule with a very long name. It introduced a proposed rulemaking on requirements for custodial deposit accounts with transactional features and prompt payment of deposit insurance to depositors. Although I think it's easier to just call that the Synapse Rule, although there has been some debate in the Twitter sphere about calling it the SVB rule, which I don't really care for, particularly given that the remarks from FDIC board members, everybody with the exception of acting comptroller Michael Sue, literally referenced Synapse in their remarks about introducing, supporting, and voting for the proposed rule. Now, what does this rule do? Most importantly, it defines this idea of a custodial account that has transactional features. So, sort of making clear what this new category is. It would require insured depository institutions that hold such accounts to maintain records that would, quote, identify for each custodial deposit account the beneficial owners, the balance attributable to each beneficial owner, and the ownership category, including prescribing a specific electronic format to maintain these records. It would also require insured depository institutions to maintain certain internal controls, including maintaining accurate account balances, as well as the respective beneficial ownership interests associated with those custodial deposit accounts, and conducting a reconciliation against the beneficial ownership records no less frequently than at the close of business daily. Um, I mean, Alex, I guess I'm going to start with a question to you, which is,
Yeah.
should it require a rule to have banks maintain accurate books and records and do reconciliation? Do we need to make a rule for this?
Well, that's a great question. I had hoped not. And if you had asked naive, young, hasn't learned the way of the world Alex from 2018, he would have said, "No, we don't need this rule. Who would not keep accurate records at all times of this happening? That's insane. Like it's an obvious best practice. Anyone who would be doing this would want to do that." Not even so much because of fear of regulatory sort of externalities that might be negative, which certainly have happened, but just because, like, for no other reason, like we're a steward of people's money. This is the responsible thing to do. This is the right thing to do. What if a bad thing happens? What if some platform we're working with goes bankrupt and there's a disagreement about how much money is in these different accounts? Like, in the worst case scenario, we need to make sure we are making customers whole and that they can get easy access to their deposits. They can find out if pass through FDIC insurance applies, if the bank were to fail. Like, this is just an obvious thing everyone should be doing. Fast forward to Alex now, who has lost some of his hair, who has darker circles under his eyes, who hasn't been sleeping for the last 6 years. And I am much more jaded and tired, Mr. Mikula. And I would say that, unfortunately, I do think this rule is probably a good thing to have. I think a couple things. One, I would petition, and this is just a sort of macro thing for me, that we stop naming rules after the people who fuck shit up, and name them maybe after the people or companies who've been sort of trying to exemplify a better way of doing this, or who've been warning about the dangers of something. So I actually have petitioned to call this the Henricks rule, after our friend Jason Henricks, because he's been banging on about the risks of FBO accounts in Bass for longer than any other person that I've known. And, again, like, should have been obvious. It was certainly obvious to Mr. Henricks. I think it was fairly obvious to us, to our friend Kia Hazlitt. But clearly there's a floor that needs to be raised in banking as a service. And so I think this rule is probably helpful just in terms of like establishing what that floor is in a more formal sense. I think it was Kia actually who pointed out on a previous podcast that FBO accounts, as they were originally sort of designed, were not contemplated as being tied to transactional accounts or transactional products, right? They were much more like a place that you would put temporarily the judgment from a court case before lawyers distributed it to plaintiffs, or any number of other sort of more traditional custodial relationships. This idea of like transactional accounts sort of being married to a custodial account, relatively new. And so I do like that we're trying to define this subcategory of custodial accounts in a more specific way and put requirements around it. My question, though, bouncing it back to you, Mr. Mikula, is would this, I mean, this is, I think, a fair test of any new rule that's proposed, particularly when it comes after a crisis. Would this have prevented the crisis from happening?
I mean, on the one hand, that's an impossible question to answer, but I do love irresponsible speculation.
That's why
So,
you're here.
uh, yeah, that's what I get paid to do. Um, I mean, there's sort of two lenses I apply to try to think about that question, right? So the first is, would this rule have even applied in the Synapse situation? And it's not
Mm,
clear that it would have. So the rule as proposed, and it's worth noting, like, this is not a final rule,
yeah.
and the two Republican appointed directors, Vice Chair Hill and Director McKernan, both
Hmm.
had some quibbles, suggestions, elements that they would like to see change. So the final form of this rule may end up looking somewhat different than the proposal. But
Hmm.
the proposed rule does include a number of exemptions, including for accounts established by broker dealers. Synapse,
Which
in
Synapse
its
was,
yeah,
yeah.
well, in its final incarnation, Synapse had a wholly owned subsidiary, which was a broker dealer, right? So the final sort of version of Synapse's modular banking approach was the creation of these technically brokerage accounts for these end users that had a cash management capability that ends up looking and feeling like a checking account when in fact it's this other thing. It's a brokerage account with cash management.
Mm,
My again, it's hard to know how this would have actually played out because it may, in practice depend on, was a bank contracting with Synapse, parent company, or was it contracting or providing services to the Synapse brokerage entity? So it's like a little bit difficult to know like exactly how that would have happened, but I do think it's a fair question to say like it's not even clear that this rule as proposed would have applied in the situation that four out of the five directors who voted for the rule said, hey, look, this bad thing happened, and that's why we need this rule.
mm,
The second, and in my mind, um, maybe more important question, right? Rules are only effective to the extent that the entities that are bound by them actually adhere to the rule. In this
yeah.
case, it's not a hypothetical about whether or not Evolve had a track record of being non-compliant with law and regulation. We have a extremely wide-reaching enforcement action from Evolve's primary federal regulator, the St. Louis Fed, ticking
Hmm.
almost every box of what you could do wrong as a bank, from board
Yeah.
governance, BSA AML, third party risk management, liquidity management. I mean, you know, pretty much everything except the kitchen sink is in that
Yeah.
consent order enforcement action. So again, the question is like, okay, let's say this rule did exist. What reason do we have to believe that Evolve or any of the other banks, involved in the Synapse situation would have been would have been compliant with it? And to what extent would Evolve or the other relevant banking regulators have been effectively supervising these banks to ensure that they had been following it? Because clearly the St. Louis Fed and the Arkansas Department of Banking were not doing an adequate job of supervising Evolve to comply with a myriad of other rules.
I think that's exactly right. And it is interesting, right? Because it's like, yeah, I fail to see sort of a scenario where the Arkansas Department of Banking and the St. Louis Fed were in it Evolve, and they were looking around and they said, "Oh, you're not really keeping very good records of these fintech partnerships you have, but technically that isn't against the law, so it's not against any rules we have, so carry on as you were doing." Like, clearly they were just, it wasn't like we looked carefully, it was not against the rules, and so we let them keep doing what they were doing. It was that no one was looking carefully in the first place. And I mean, you and I have both, I think, been very critical of how long it took Evolve to get a public consent order. That's probably more a mark of the skill of their lawyers than anything else in terms of delaying that action. But I think at the end of the day, you make a really good point. And the thing I'm curious about coming out of this proposed rule, if it ends up getting finalized in its sort of current form, more or less, is for the FDIC and for all of their regulatory agencies that they partner with on exams and on supervision, what's going to change, right? Like what are they going to do differently than they've been doing before? How are they actually going to confirm that this rule is being complied with? Are they going to audit the ledgers of the bank? Are they going to audit the ledgers of the fintech programs or middleware platforms that are maintaining external ledgers to see if there's a discrepancy between those two things? I know for a fact that certainly auditing of non-bank ledgers was not something that was happening, but I kind of can't think of how else you would really confirm that the records are accurate unless you did some level of that work. And this ties in actually to a proposal I'm trying to get people on board with. This is my fintech bank nerd influence campaign, but I actually think if the FDIC and other regulators are going to put more scrutiny in this particular area and really try to confirm that this record keeping is being done well, which, among other things, again, should actually make it easier to determine if things like pass-through insurance apply in the case of a bank failure, which again was not the situation with Evolve and Synapse, but you could certainly see happening in the future. I actually think the End FinTech program should pay an assessment fee to the FDIC, right? Because really, in a broad sense, this rule and what we're talking about is how do we sort of rejigger the umbrella of trust that sits over all of this, right? And I always like to go to fintech companies' websites and remind myself of the language that's at the very bottom. And so I was looking yesterday at a couple of them, and it says on the page member FDIC on there, right? And of course they're in reference to the bank partners that they're working with, but on the fintech company's website it says, in those words say member FDIC. And as we've talked about many times, when a consumer sees member FDIC, they don't really ask much more beyond that. And so this trust infrastructure that we have, and this rule, I think, in some ways clarifies the responsibility of people operating under that infrastructure. It needs to be paid for and maintained as well. And so I think a question, and Kia Hazlitt somewhere is listening and is nodding her head frantically that she's won this debate, but like, what is the liability that fintech companies have around this? What is the accountability that they have? What do they have to pay to contribute to this? Because I do think we've already seen the movie play out of, oh, this is all entirely the bank's responsibility. The regulators are going to ask a couple questions to the bank, but they're not really going to look at like what the answer is. And we'll just sort of hope and expect for the best. That didn't work, right? Like expecting that this would have been obvious to banks in this space and that they would have been doing a good job here just because that's the basics of running this type of business. That didn't work. There is a set of banks that will underperform that expectation, and fintech companies and middleware platforms that will underperform that expectation. So bringing this rule up to the baseline, I think, does make sense. Last question I have for you on this story, Mr. Mikula, is how is this going to affect the broader banking as a service market? Because you and I think both think about it in the same way, which is supply and demand. This is yet another thing that might, I guess, constrict supply a little bit. What's your take on that?
Yeah, I think that is a reasonable analysis or a reasonable question to ask based on what we know at the moment, right? So we have
Yeah.
seen, we've seen broadly de-risking with some partner banks staying in the business line, but maybe exiting certain programs that were higher risk or just less significant to their overall P&L and balance sheet, right? I mean,
Hmm.
particularly, I know that Coastal was ahead of the curve as far as working to sort of streamline the number of programs that it worked with. And
Hmm.
that's, public information because Coastal is publicly traded. Um, Others have chosen to exit in the fallout from enforcement action. So Blue Ridge after its
Yeah.
second enforcement action and MCB.
Yeah.
I do think a notable and recent data point is Five Star, which in mid-September, its parent company announced that Five Star would be winding down its BaaS business, and that would be effectively complete sometime in 2025. the news release cited that it was a quite small share of deposits. I think about 2% of the bank's deposits and less than 1% of the loan volume. And the CEO specifically pointed to a evolving regulatory environment, including specifically citing the broker deposit rollback. And so, yeah,
Mm,
I mean, if you're a bank in the space and you see this rule coming, I mean, looking at the composition of the FDIC board, it's almost certain that it will pass in some format, even if you lose the support of the two Republican appointed members. And you're saying,
yeah.
hey, like this is going to mean incremental work, incremental cost, incremental staffing to continue running this program. That does change. That changes the economics. And so it's like, okay, again, if I have to do this incremental work to support my fintech lines of business, my fintech partner programs, the the positive economics from supporting those programs needs to be higher now. So maybe
Yep.
that means
Yep.
I want to see more, debit card transaction volume to generate my share of interchange income, or I want to see a larger amount of deposits in a given fintech program to sort of clear that threshold bar of like break even to make it worth it. Costs have gone up,
Hmm.
and so I think that will effectively end up constraining supply. One more very quick comment on this, I promise, and then we can move on to the next one. I did want to call out part of Rohit Chopra's comments when he introduced his support for the rule. So, Director Chopra from CFPB sits on the FDIC board, and he referred to a quote unquote significant incursion into deposit taking by firms that are not banks or credit unions, and said, quote, these firms want the public benefits of being a bank or credit union without the public obligations. That's actually an argument I've made before, and often I actually don't necessarily agree with Director Chopra, and actually, interestingly, ticks and ties to the idea that you were proposing. And here I thought Alex was supposed to be a fintech cheerleader, according to the Capital Account newsletter.
Yes.
But I do think I refer to it as the idea of fintechs, non-depository, non-bank companies having this unearned benefit, this trust halo that Americans
Yeah.
have in the banking system, that they're not paying for, and that is, you know, how you think about sort of dealing with that or compensating for that uh, unearned benefit, that positive externality. Um, I think is sort of what industry is grappling with.
I get a lot of questions about what you should look for when choosing a fintech partner bank. And at the top of that list are security, compliance, and operational resilience. As you know, I'm a huge advocate of building and scaling products responsibly. Nothing grinds my gears more than when companies move fast and break things. With Newline by Fifth Third, you don't have to sacrifice anything. You get the innovation of a modern developer platform with the stability and compliance competency of a leading bank. With an API-first platform, Newline enables enterprises to launch and scale payment, card, and deposit products directly through Fifth Third Bank. No annoying or expensive middleware layers to go through, just a secure and direct relationship with Fifth Third Bank. Find out more about Newline by visiting newline53.com.
Should we move on to our second topic, something we haven't talked about recently that you are far more up to date on than I am?
Yes, we can definitely do that. So, as some folks may be aware, hopefully you are aware, we are in the end game, Jason, for open banking in the US. So, obviously, the CFPB has proposed a personal financial data rights rule, aka open banking, based on their authority under Section 1033 of the Dodd-Frank Act, which has been quietly defunct for many years. The rule is finally getting finalized. So they proposed it last year in October. They have said and committed publicly that they will finalize it in October of this year. So by the time folks are listening, we will be in the month in which this rule is going to be finalized. Likely that is going to happen at Money 2020. Director Chopra has a flair for the dramatic, as we know. And so I would hazard a guess that that rule is going to be finalized right around that time, probably accompanying a speech or public remarks of some kind, and it's very exciting. One of the small but very dramatic corners of this whole move to a regulatory driven open banking system in the US is industry standards. So the industry, banks, fintech companies, data aggregators, they reasonably would like to know what technical standard they should be building to. We are moving away from screen scraping to APIs. That's a core sort of tenet of the proposed rule under 1033. But exactly what is that API standard? What is the specification? What needs to be supported? That is a question that the CFPB would like to have answered by an independent industry standard setting organization, or SSO. And in its proposed rule, it talks a little bit about how it will go about designating a officially designated SSO for open banking in the US, and essentially empower some organization or multiple organizations to set those standards. Interestingly, they actually finalized the portion of the personal financial data rights rule that relates to standard setting. So even though we're waiting for the rest of the proposal to be finalized, a portion of it actually has already been finalized, specifically around standard setting, because the CFPB knows, A, that the industry needs a standard, and we can't finalize the rule and start the deadline for when you need to be compliance for it, which, by the way, at least under the proposed rule, that first deadline comes 6 months after the rule is finalized, which is pretty fast. We can't reasonably expect compliance with such deadlines if we don't tell people with as much advance notice as possible what specification they need to be building towards. The second piece that the CFPB understands and that they're trying to push for is uh, there is a very legitimate set of concerns that if the wrong standards body is empowered, um, there could be challenges in the way that this sort of personal financial data rights rule is actually operationalized. And I had the chance to see Director Chopra speak in person a few months back about standard setting for open banking, and he referenced plenty of other industries because he kind of has that sort of antitrust, sort of anti-monopolist viewpoint generally across industries. He referenced plenty of other industries where standard setting organizations end up getting stacked by certain industry participants, and the standards themselves end up benefiting incumbents or specific parts of the market and don't end up sort of serving the whole market well. So the CFPB has this concern. Specifically, they have this concern about the Financial Data Exchange, or FDX, which is the dominant standard setting body around data sharing in the US and Canada. It is the obvious choice, and really, I think, the only choice for a standard setting body around open banking. There's really no one else that the CFPB could turn to do this. But the CFPB and the FDX have actually been playing kind of an interesting game of chicken over the last, I would say 6 to 12 months, because, FDX knows they're the obvious choice to be the standard. But the CFPB has expressed concerns, I think privately and in a more veiled way publicly, about certain elements of how FDX has historically been structured. So FDX is a industry-wide standard setting organization. It includes data aggregators like Plaid and MX and Finicity and Akoya. It includes big banks like JP Morgan Chase. It includes some fintech companies and consumer advocacy groups, but mostly it's been kind of a two-sided organization between big banks and the big data aggregators. And the CFPB has expressed some concerns that FDX might a little bit be over indexing on the interests of big banks. And so they talk a lot about, a good standard setting organization has unbiased, decision making across all levels of its organization, all the way up to the board. It has equal representation across multiple different industry stakeholders. And I think when they look at the sort of current composition or the historic composition of FDX, they see an organization that is dominated by big banks in a lot of ways, And they see an organization that doesn't have the active participation of some very key stakeholders. So in this case, it would be things like small banks and community banks, which really haven't engaged tremendously through FDX around standard setting, and in a lot of cases have sort of left FISERV or FIS or those types of organizations to sort of represent their interests. Same thing for fintech companies. A lot of the data aggregators are very actively participating in FDX, but you don't see as many fintech companies, big or small, doing it. They're, again, sort of outsourcing their interests to the data aggregators and hoping that those interests are well represented. So the CFPB wanted to see a bunch of those things change, and it looks as though the FTX has actually made a bunch of those changes. So FTX has officially applied for becoming the standard setting organization for open banking. You can actually go to the CFPB's website and look at the application that FTX put in place. And FTX also announced a new CEO, in fact, their first ever CEO, Kevin Feltus, who is joining from JP Morgan Chase, where he was the head of partnerships and strategy for the Connected Banking Group. So essentially, sort of the guy in charge at Chase of their open banking strategy. And he has been serving on the FDX board for a number of years. So that is kind of where we're at. My sense is that FTX is going to end up becoming the standard setting organization. I think they're going to, in some ways, sort of win the game of chicken with the CFPB. Both swerved out of the way, I think, at the last minute, but I think maybe the CFPB swerved slightly more just because they are sort of out of time. But FTX has definitely made some changes, both big and small, to address the CFPB's concerns. So, Jason, let me just ask, did that make sense, or am I too deep in the weeds on open banking?
I mean, you are definitely much more in the weeds and the details than I am. I did, as I was preparing for this earlier today, take a scan of who is on the FDX board of directors, and it did strike me that you, to your point, you really have no direct representation of small banks or of consumers, with the exception of a representative from Consumer Reports. But otherwise, it's basically big banks, some big brokerages, associations that also represent big banks, like the clearinghouse,
Yes,
um,
yes.
and the aggregators. So I guess, I mean, it's interesting to kind of try to think through those dynamics and ask the question, are the data aggregators, are companies like Plaid, MX, Finicity, are they well positioned and are incentives aligned such that they're actually representing the interests of consumers, of end users, and of those small banks who are, as best I can tell, not really directly represented in any way. And I hate to dodge and make you answer that question. I feel very poorly equipped to think through, do the aggregators, are they positioned to represent the interests of end users? Are those end users' interests aligned with them? Or, I mean, obviously their interest is make a bunch of money and IPO. And
Yeah.
is that, is that closely enough aligned with what end users, really want to come out of a standard setting body?
Yeah, no, it's a great question, and it's the one that the CFPB has been obsessing over the last year or so. I mean, they've been like hyper focused on standards and nailing the standards, and I think it is because Director Chopra, I think, wisely understands that once the standards sort of get away from you, it's really hard to pull them back. And so they're trying really hard to push the standard setting process in a direction that's going to be as neutral for the industry as possible and represent the stakeholders across the board: consumers, fintech companies that are small, fintech companies that are big, small banks, big banks, the existing large data aggregators, newer data aggregators that might come into the market. So they want it to be an equal playing field for everybody. And I do think, it is, and I've been critical of this before, I do think it is a mistake on the part of smaller banks and fintech companies to have not been as engaged in this up until now as they probably should have been, right? Because as much as you might sort of assume, like, oh, we're a fintech company, we work with Plaid or we work with MX or we work with Finicity, I'm sure they'll represent our interests accordingly. Your interest as a fintech company might not be exactly aligned with the interests of the data aggregators. And by the same token, a community bank's interest in open banking might not be exactly aligned with the interests of Fiserv. And so I do think that, you know, broader participation, including more participation from consumer advocates, not just Consumer Reports, but others as well, I think that would be very beneficial. The other thing that I thought was interesting, and I've gotten some interesting sort of commentary around since I shared this online, was the CEO who's coming in, Kevin from JP Morgan Chase. On the surface, I think that doesn't necessarily do a ton to reassure the CFPB that big banks aren't in charge of standard setting, because he was working at Chase. He's still in the process of transitioning from Chase over to FTX. However, I have been told that I don't know Kevin at all, but from folks who've worked with him, including folks at the data aggregators who sometimes have a bit of a contentious relationship with Chase, fintech companies, that he is very much seen as someone who will do a good job leading FDX. That even though he worked at Chase, that just means he sort of understands the big bank perspective on this stuff, but that he's not, wedded to just defending that one perspective, and that he will be a good neutral sort of arbiter for taking FDX and the standards around this stuff into the future. So people seem very enthusiastic about him and his position here. And in some ways, I guess the other way you could think about it is, in order for someone who works at Chase to end up in this role, he'd almost have to overperform in some of those other metrics in terms of getting trust from the broader set of stakeholders, or they never would have signed off on it in the first place. So I do think that probably it will end up pushing the standards body in a healthy direction. I think FDX has historically spent a lot more time on like tokenized data access and APIs, which was a big focus for banks from like a data security and a performance perspective, but is probably not the only thing they should have been working on. There's probably other stuff with like the actual standard that maybe they're a little behind on and that they need to kind of drive towards. It did say FTX put out a press release recently announcing some of this stuff, and buried in that press release, it did say that they are now their API is used for 94 million consumer accounts, which is a lot. And so that is a great deal of the traffic already in the open banking ecosystem in the US already flows through the FTX API. And so again, they're pretty much the only choice to be the standard setting organization. And I think that is how it's going to end up here.
Well, and I think there are a lot of things that government can do well. I do not think drafting like technical API specs is something that anyone wants the CFPB to be doing, including the CFPB.
That's right. That's exactly right. And it's funny because the CFPB did threaten to do that, right? In the speech I referenced earlier that Director Chopra gave, where he was really playing chicken with FDX, and I saw it up close. He said, "We're prepared to do this ourselves if you don't do it the right way." And so, that was the threat, but he doesn't want to do that. His staff doesn't want to do that. No one in their right mind wants a government agency setting technical specs. There actually have been other countries where the government has been more involved in setting the technical specifications or defining like some of those more sort of prescriptive kind of requirements. And Director Chopra has actually talked about this. A lot of that has backfired. It freezes the technology in a particular place. It doesn't allow it to evolve. And so this is the best outcome, I think, both for the CFPB and the industry. And we were always going to end up here, and we ended up in a compromised place. The last thing I'll mention as this relates to all this, because you actually broke the news on this back in the day, is there was a little bit of drama around certain banks and brokerages and others not playing nicely in the open banking sandbox, PNC and Fidelity specifically. And they had at one point had a plan to basically only allow consumers, their customers, to share their data if the companies accessing the data went through Akoya, which is the data aggregator that is owned by a consortium of big banks, including the banks that own the clearinghouse. Um, that, from what I can tell, has kind of been gently backed away from, particularly on the banking side with PNC, because PNC's data is covered under 1033, whereas like brokerage data is a little different. So that's kind of a different thing. Interestingly, PNC seems to be playing slightly nicer in the open banking ecosystem over the last couple of months. There was just an announcement that they've actually entered into a data sharing agreement with Plaid, who they previously sued over some kind of trademark related concerns. I've actually heard that this agreement is one of the sort of outcomes of that settlement for that lawsuit. But it does, I think, mark a slight sort of unfreezing of that relationship. Bill Demchek, the CEO of PNC, has come out publicly in a hilarious quote. I think I actually showed you this quote when we were together in New York, but he said that we're going to use open banking to essentially destroy our smaller competitors that don't have the technology to keep up. And if regulators want to make it so that it's easier for consumers to switch accounts or move their money, we'll take advantage of that and take those deposits. And so kind of a mercenary attitude, but at least it is viewing open banking as an opportunity rather than just something we have to throw our bodies in front of and stop. So I do think even the most recalcitrant large banks, when it comes to open banking, are starting to get on board in a way that they weren't before.
Absolutely. Should we give the 3-minute overview of the Visa antitrust suit, which clearly can
I
be
think you can.
summarized in three?
I think you can do it. I'm so excited to hear you do it in three
Okay.
minutes. Jason Mikula,
All
go.
right. Okay, speed read. So, the latest installment in the interchange saga drama,
Yep.
Department of Justice filed a civil antitrust lawsuit against Visa, which is centered on the accusation that Visa has illegally maintained a monopoly over debit network markets in the United States by leveraging its dominance to thwart the growth of existing competitors and prevent others from developing new and innovative alternatives, including using anti-competitive pricing strategies, minimum volume commitments, and cliff pricing. I'm making air quotes. Basically, to make it financially unattractive or not viable for certain merchants or merchant acquirers to route volume onto competitive debit networks.
Mm-hmm.
Also accuses Visa of using partner contracting and incentive payments basically to discourage newer tech entrants like PayPal, Apple,
Mm-hmm.
Cash App, Venmo from becoming competitive to Visa's debit rails. Everyone will remember the infamous Plaid volcano from the
Oh
Department
yeah.
of Justice lawsuit blocking Visa's acquisition of Plaid. It was evidently that case that actually laid the groundwork and gave rise to this civil antitrust lawsuit. So I guess
Mm.
Visa's just the punches just keep on coming. They didn't get to acquire Plaid, and it turned into this antitrust lawsuit. I mean, I think given that we do not have time to discuss all of the particulars, I would point out it's just like the latest in a long string of actions or proposed actions related to either interchange or the sort of Visa MasterCard duopoly. So in summer 2023, we had Reg II being extended to card not present transactions. So basically, the requirement to have routing available for a non Visa MasterCard debit network. We
Mm-hmm.
have the like multi-decade, I think at this point, Visa MasterCard class action case brought by merchants that there was a proposed settlement. That settlement was rejected by the judge overseeing the case. We
Yeah.
have the Fed, for the first time since the passage of Dodd-Frank and the Durbin Amendment, the first time the Fed has actually revisited that price cap for covered transactions, which they've proposed lowering. And of
Mm-hmm.
course, the Credit Card Competition Act proposed legislation in Congress, which would uh, require a similar unaffiliated routing mechanism for credit cards issued by banks with more than 100 billion in assets. Last but not least, there was a MasterCard FTC case and settlement about MasterCard's tokenization practices and the corresponding constraints on transaction routing back in 2022. So surely
Mhm.
everyone understands the particulars of every single one of those cases or proposed actions. I mean, I think the high level takeaway is the fight about payment processing costs, interchange, who's bearing them, who benefits, is just a perennial hot button issue that tends to bubble up from time to time, and it is certainly bubbling right now.
Yes, that is absolutely true. The only thing I will add to your excellent summary, Mr. Mikula, that was great, is that I'm kind of a yes and person with this topic, right? Where it's like, yeah, I think yes, obviously Visa has done some things that any large incumbent business would do to protect and preserve their business in this space. Like obviously they have, and I don't think like we should be shocked about that. And some of those things tread very close to the line of like anti-competitive practices that the government would be concerned about. I think that's totally fair. They don't want merchants, they don't want to make it easy for merchants to route debit transactions over other networks. So they're going to do as much as they can to discourage or stop that from happening. The agreement with Apple over Apple Pay and getting them special pricing, which the banks freaking hated, was entirely premised on the idea that we need to stop Apple from building their own closed loop network that could compete at scale with us. Their desire to acquire Plaid was entirely based on open banking is going to make pay by bank easier, and we need to have a foot in that world because it might eat into debit transactions. I think all of that is totally true. Ron Shevlin pointed this out on LinkedIn, so I want to give him credit for this. It's also true that if we just decided to turn off all debit cards or credit cards for a day, merchants would be so incredibly screwed. And merchants, particularly the largest ones like Walmart, have a passionate dislike of the card networks. But the reality is, debit cards and credit cards are incredibly valuable to merchants. The 2 to 3% is a fee that annoys them because they've gotten used to the benefits of credit cards and debit cards without understanding the massive cost that they would have to incur if they didn't have those. And that there wasn't, again, this like trust halo that everyone benefits from in the commerce space. That trust halo is paid for by that 2 to 3%. And so I am deeply annoyed both by Visa acting like this is completely out of the realm of what are you talking about? We wouldn't be anti-competitive. Like, of course you would be. And I'm also deeply annoyed by people arguing that, oh my God, Visa has stifled all this competition, and merchants would have all these other great options, and debit cards are just like a tax that merchants have to pay. No, that's not true either. They're a great product. They work really well, and a lot of that cost goes towards creating trust, which is super valuable. Jason, I feel like I just already did my rant, but before we wrap up, can we do a quick can't let it go?
Yes, we can do a quick can't let it go. I will go first. I will
Okay.
keep it very brief. I think we both wrote small chunks about this, which is
Yeah.
TD Bank's consent order with the CFPB, which stemmed around FICRA issues and specifically credit furnishing. And if you
Yeah.
just read like the press release or like the CFPB statement, it sounds like fairly anodyne, like, oh yeah, like they messed up some furnishing stuff. If you actually read the consent order, which is quite lengthy, I want to say it was like 40 plus pages, it is a
Mm.
laundry list of like every single thing you could do wrong when furnishing, either
Yeah.
not noticing that you're doing it wrong, noticing and not bothering to fix it for years, using
Yeah.
vendors that are doing stuff. It was just like, how can you be this bad at credit furnishing when you
Yeah.
are a bank and one of your businesses is lending people money? And I will leave it at that.
I love it. I would just add that if we could update Metro 2, that might make it easier for people to furnish data in a way that makes sense. And I would also add that we absolutely need some type of like tighter feedback loop to disincentivize people from sucking so much at furnishing. I mean, the TD Bank having to pay $27 million to the CFPB is something, but it's happening years after they screwed up. We need a tighter feedback loop to stop this from happening. My quick one is folks probably saw a title in for an article in Forbes. The title was "Plaid's former billionaire CEO has a bold plan to revive its growth." And Jason, what what kind of headline is that? That's like the worst headline. It's a great article. Jeff at Forbes did a wonderful job writing it. It's really interesting. It's got a lot of great details on Plaid and their CEO Zach Perret, who I guess was a billionaire technically on paper and now technically not on paper isn't a billionaire. But that's a really badly worded headline that for a second I was like, is William Hockey back leading Plaid? Like, what do you mean former? What do we like? This is very strangely worded. So if editors, particularly at Forbes, could do a better job writing headlines on great articles, that would be amazing.
Yeah, that the copywriter in me was just like, is he a former billionaire, a former CEO, or former both of these? It's bad copywriting.
It is bad copywriting. And but above everything else, Jason and I are craftsmen as it relates to the writing of words. So we take these things seriously. Jason, I think the next time I see you, it's going to be in person at Money 2020, which I'm looking forward to. Yes. So we will catch up then. But until then, thank you, sir. This was fun.
Absolutely. Till next time.
To this episode of FinTech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love FinTech Takes, please tell a friend.